Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the RiskSpotlight Portal, the premier forward-looking service for operational risk content. Let's get started. This week, we delve into key updates on artificial intelligence, cybersecurity regulations, operational threats, and sustainability reporting. Starting in Europe, the European Data Protection Board issued an opinion on personal data use in AI, responding to concerns from the Irish Data Protection Commission about GDPR compliance. The EDPB's framework allows AI developers to use legitimate interest as a basis for training models, but requires adherence to strict safeguards. These include risk assessments, data minimization, and transparency throughout the AI lifecycle. The board highlighted the critical role of anonymization techniques and governance practices, such as audits and documentation, to maintain compliance and public trust. Additional guidelines addressing issues like web scraping and automated decision-making are forthcoming. The emphasis on regulatory clarity marks a step forward in balancing innovation with data protection in the EU. In Hong Kong, the Financial Services and Treasury Bureau issued a policy statement promoting the responsible use of AI in the financial sector. Their dual-track approach balances innovation with risk mitigation, emphasizing data privacy, intellectual property protection, and operational resilience. Collaborative initiatives like the Generative AI Sandbox offer practical applications under supervised conditions, aiming to foster transparency and accountability. Recommendations for AI governance include ensuring diverse and high-quality training data, robust cybersecurity safeguards, and human oversight to prevent biases and inaccuracies. Moving to the U.S., the Securities and Exchange Commission's cybersecurity disclosure rules have resulted in a 60% rise in incident reporting since their introduction last year. However, less than 10% of these reports include material impacts, leaving gaps in understanding the broader implications of incidents. The SEC's regulations require public companies to report material cybersecurity events within 4 business days, but challenges remain in defining materiality, particularly for third-party breaches. Notably, sectors like finance, healthcare, and automotive retail have seen significant activity, with ransomware and third-party vulnerabilities posing ongoing threats. Companies are encouraged to conduct tabletop exercises to refine their incident response strategies, as repeated disclosures for the same events highlight a learning curve in adapting to these requirements. Phishing attacks continue to evolve as a significant threat. Phishing-as-a-Service platforms have made launching attacks easier, enabling even novice cybercriminals to execute sophisticated campaigns. TrustWave reports that phishing accounts for 49% of all cyber attacks, and smaller institutions, such as credit unions, remain attractive targets. Insider threats, both accidental and malicious, further compound these risks. To mitigate these challenges, financial institutions are urged to adopt robust insider threat detection systems, limit access permissions, and conduct regular phishing simulations. Cyber risks driven by advancements in AI have also surged. Deepfake attacks are becoming increasingly sophisticated, with cases such as a finance worker in Hong Kong transferring $25.6 million to scammers after being deceived by deepfakes of colleagues during a video conference. Reports from iProve reveal a 704% rise in face swap attacks targeting biometric systems. Meanwhile, shadow AI, unapproved use of AI tools in workplaces, has raised concerns about data disclosure risks, as highlighted by Cyberhaven, which found a 485% increase in data submissions to AI tools over the past year. Organizations are working to implement comprehensive AI security policies to address these risks. Shifting focus to North Korea, investigations reveal that the regime has been infiltrating U.S. companies using fake identities to secure IT roles. These operatives generate revenue for the North Korean government while posing significant cybersecurity risks. The Department of Justice has dismantled schemes involving remote IT workers logging in from abroad via laptop farms. Companies are urged to implement stricter hiring practices, such as rigorous background checks and monitoring for remote administration tools to prevent such breaches. In the realm of sustainability, concerns about greenwashing persist. The SEC's climate rule and California's Climate Accountability Acts aim to enhance transparency in emissions reporting. However, inconsistencies in sustainability disclosures, coupled with a lack of internal controls, have created an environment where misrepresentation thrives. The International Sustainability Standards Board's new IFRS Sustainability Disclosure Standards and the ISB's proposed ISSA 5000 aim to establish global benchmarks for trustworthy sustainability reporting. Organizations are encouraged to align with these frameworks to improve reliability and mitigate the risks of greenwashing. Finally, a spotlight on service disruptions. PagerDuty's recent survey found that 88% of IT and business executives anticipate another major incident within 12 months. July's global IT outage exposed preparedness gaps, with many organizations reporting lost revenue and delayed responses. Executives are now prioritizing real-time data tools and proactive incident management to mitigate future risks. A shift towards continuous improvement, rather than one-off investments, underscores the growing recognition of resilience as a strategic imperative. Now let's turn to key operational risk loss events reported last week. The first update is about banking disruptions affecting customers in Australia and New Zealand during the holiday season. ANZ Bank experienced internet banking issues in New Zealand on Christmas Eve, coinciding with a major outage at Bendigo Bank in Australia. Bendigo Bank's 3-hour outage left thousands of customers unable to access phone app and e-banking services. The next update is about a significant settlement system outage at the Australian Securities Exchange, ASX, causing major disruptions in the financial markets. On Friday, December 20th, 2024, the ASX experienced a critical failure in its clearinghouse electronic subregister system, CHESS, which halted trade settlements and left brokers scrambling to secure billions of dollars to cover unmatched transactions. Engineers worked through the weekend to resolve the issue, narrowly averting a potential delay or cancellation of Monday's trading session. This incident marks the worst market disruption for the ASX in 4 years, putting the exchange operator under intense scrutiny once again for its technological vulnerabilities. The next update is about a major banking scandal involving Westpac New Zealand, overcharging thousands of customers. Westpac NZ has admitted to overcharging more than 24,000 customers approximately $6.35 million due to systematic failures in its discount and benefits programs. The bank acknowledged making misleading representations to customers through its employee, gold, and platinum packages, as well as other business banking services, with violations occurring due to manual processing errors and inadequate system controls. The Financial Markets Authority, FMA, in New Zealand has initiated court proceedings against Westpac, highlighting that up to 31% of eligible customers did not receive their entitled discounts on products and services, while small business clients were particularly affected by incorrect charge codes leading to higher fees. The next update is about Bank of America facing regulatory action over anti-money laundering deficiencies. The Office of the Comptroller of the Currency, OCC, has issued a consent order against Bank of America, the second largest bank in the United States, to address shortcomings in its anti-money laundering AML operations. The bank has been directed to rectify issues concerning the timely submission of suspicious activity reports and to address a previously noted shortfall in its customer due diligence procedures. While Bank of America did not incur any financial penalties, it will be required to undertake various measures to enhance its regulatory compliance, including developing strategies for evaluating new clients, conducting risk assessments, and engaging an independent consultant to ensure proper reporting of suspicious activities. That concludes this week's Operational Risk Updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.